Are you concerned about volatility in the stock market? Are you sitting on a large position in your company's stock? Or did you recently sell a property or an other asset like stock or a small business that had capital gains? And if so, are you dreading the capital gains tax bill that will come due with the IRS? What if you could take some of those gains off the table? You could sell stock right now and reinvest those gains into rental real estate while deferring capital gains tax until the end of 2026. And at the same time, what if you could get full capital gains tax relief on any subsequent gains from those reinvested profits? Philip Ma here from eXp Realty. In this video, I want to talk about the Opportunity Zone federal tax benefit and how you could potentially achieve these different benefits. Now, if you're finding value at any point in this video, don't hesitate to hit that like, subscribe, and bell notification button. Let's get going. Before I get started, I want to provide a disclaimer. The tax information provided here is not intended as legal or tax advice. I'm providing it based on my own general knowledge of U.S. tax law and my own experience as a real estate investor. You should always check with your tax professional on potential tax benefits that may apply to your situation. I'm a real estate agent and an investor, not a tax professional. All right, but the answer here to potentially getting some capital gains tax benefit is the Qualified Opportunity Zone federal tax benefit. And I myself have taken advantage of this benefit. I've invested in a portfolio of rental properties located in opportunity zones. Now, let's just get a little context here. If you look at the S&P 500 index from over the last 3 years, it's been pretty volatile. It went way down at the beginning of 2020 when the pandemic hit. Then it went way up to an all-time high at the beginning of 2022. Then it went back down, and then over the last year, it's come back up. So you might be thinking, I want to take some money off the table, or you might have a concentrated position in your own company's stock and not want to be subject to all this volatility, or to have some diversification. So let's go through the Opportunity Zone tax benefit basics, or OZ for short. So what would the Wizard of Oz do with this tax benefit? Well, to start out, you have a capital gain from the sale of assets. Now, those assets could be real estate, but it could also be stocks, bonds, crypto. Maybe you had a small business that you sold where you realized some capital gains. Now, within 180 days of realizing those gains, you can invest those gains into a qualified opportunity fund, which is either a corporation or a partnership. Now, don't be detracted from having to invest in this fund, because you could set up your own fund, your own QOF, with one or more individuals. Your QOF must then invest in real estate, which is called Qualified Opportunity Zone business property, that's located in a certain designated census tracts within that 180 days. Now, there are institutional funds that are set up, a lot of times a syndicated network of investors that pool their funds and invest in property. However, again, you don't have to limit yourself to those big funds. You could set up your own fund and have more control over the rental properties. Now, the real estate that you invest in, it must either be brand new construction, which is called original use, or it can be a fixer-upper property that you improve, and there is a specific requirement of substantial improvement where you have to at least double the cost basis of the building. So if there's an existing structure, you have to at least double the tax cost basis of that building. And I'll get into more details on what that means. What are the benefits? Well, you get federal capital gains tax referral on that gain that you realized until the end of 2026. And on top of that, and this is really where the huge benefit comes in, is you get full capital gains tax relief on any subsequent gain in that real estate that you invest in if you hold the property for at least 10 years. So this is a long-term investment. To achieve that full gain, you have to hold for at least 10 years. All right, so this is just another view of the whole process of taking advantage of this opportunity zone tax benefit. So on the top left corner, you start with a capital gain that you realize from the sale of capital assets. Now, if you're thinking about selling a big chunk of stock, then you could plan ahead, and we'll get into the types of planning that you want to do in advance. If you've already sold that stock, then you have a 180-day period, basically about 6 months, to go through the steps that you see here. So that gain has to be invested into that qualified opportunity fund. And again, you could set up your own fund. You could set up an LLC with a minimum of one other person, and that person could potentially be your spouse. You set up that LLC as a partnership or a corporation, and now you can go shopping for rental property. That property must be located in a specific opportunity zone. It's a census tract that's been designated by the federal government, and I'll provide you with a list or a link where you can go and see that list of different census tracts. Okay, again, the real estate has to be either brand new construction or a fixer-upper that you're prepared to invest in improvements to it such that you double the cost basis. And at the end of the day, once again, you're going to get deferral on your current capital gains up till the end of 2026. And you're going to get this huge benefit where any subsequent gain is going to be completely capital gains tax-free. You will get a full step up in your cost basis of those subsequent gains if you hold for at least 10 years. Now, where are these opportunity zones located? Well, there are opportunity zones in all 50 states, as well as Puerto Rico and the other U.S. territories. So really, there's zones all over the place. And if you go to this link that you see here, and I'll have this in the description below this video, you'll see a list of where those census tracts, what they are, where they're located. What about the San Francisco Bay Area, also known as Silicon Valley? Are there opportunity zones? Yes, there are. Now, on this map here, you can see the areas shaded in dark gray are opportunity zones. And generally, you have some in the Brisbane and San Francisco, parts of San Francisco. On the peninsula, you have East Palo Alto and Redwood City. In the South Bay, you have parts of Santa Clara County, as well as San Jose. On the East Bay, you have an area in Fremont, as well as Hayward and surrounding areas. You have a really big chunk of Oakland as a designated opportunity zone. And then you have areas of Berkeley. So there's a lot of areas that you can invest in the Bay Area. All right, let's go through some numbers. I'm going to take an example of a house in East Palo Alto that was on the market at the beginning of 2023, located in an opportunity zone. And I'm going to kind of apply the BRRRR method. BRRRR, that acronym, stands for buying, rehabbing, renting out, refinancing, and repeating. This is kind of a standard strategy that investors are applying today, and this can be applied to an opportunity zone property. So this property in East Palo Alto has 2 bedrooms, 1.5 baths. It's on a 5,000 square foot lot, and it was not in very good shape. It was not updated. It had not been updated in years, and I think it was built in the 1940s. It sold for $950,000 on January 28th, 2023. Now, if I just roughly approximate the value of the land versus the value of the building, I would say that the value of the land is probably about 2/3 or $600,000, and the value of the building is maybe $350,000. And you would want to get an appraisal or a cost segregation analysis done because it's very important to separate the value of the land from the value of the building. The reason why is because the value of the building is the value that you need to improve that property under the opportunity zone tax rules. So that $350K is the amount that you would be required to spend to improve the property. And those improvements would be things like adding a bedroom, adding square footage, maybe building an accessory dwelling unit on the property. And this property, it actually had a detached structure in the backyard that was being used as an office. I would say that that was just a tear down. It wasn't in very good shape. So as an investor, I would probably just get rid of that structure, but then build an ADU, accessory dwelling unit, that was nice and could be rented out separately. So if you were going to rent out this property, you could potentially do an Airbnb rental, short-term rental, or medium-term rental, where you can rent out the main house, and then you could also rent out that separate ADU in the back and try and maximize your rental income. So let's say you put that $350K into the property. So, and again, this is going to be from capital gains that you put into your QOF, your Opportunity Zone Fund. So your total cash investment would be $1.3 million. Now, let's say you didn't have that much gain. Could you finance this acquisition and the improvements of the property? The answer is, under the Opportunity Zone tax rules, there's nothing to stop you from taking some cash, putting it into the acquisition, but also financing part of the acquisition as well as the rehab cost. That's pretty standard in doing investment properties, is to go out and get either private money or a bank loan to acquire the property and do those improvements. There's nothing to stop you to do that as with an Opportunity Zone property. Then once you've done all the improvements, and let's say that you rent it out either as a long-term rental or a shorter or medium-term rental, you then go and do a cash out refinance where you take the original loan. Let's say it was a short-term rehab or construction loan. You take cash out once the property is stabilized, pay off that original loan, and then you probably have some additional cash. Let's just say that it was 75% loan to value loan that you took out, and then you went and got an appraisal, and it appraised at least 1.3 million. Presumably it could appraise in this current market at higher than that. So then you're taking out 1.1 to 1.3 million in cash. Again, if you financed some of that construction cost, you'd have to pay off probably that loan that you took out initially, but you would still have cash that you could then redeploy into another property. So you're applying the BRRRR method to your Opportunity Zone investments. It's a beautiful thing. What is my call to action? Well, first of all, you need to get some market awareness of where those Opportunity Zone properties are. As I said, in the Bay Area, there are definitely areas that have these designated census tracts. And one thing to note about these census tracts is they're defined as low-income areas compared to surrounding areas in that region. So, for example, East Palo Alto, it would be defined as a low-income area. But a census tract can cover a lot of area and a lot of neighborhoods. So even though the bulk of that area might be an area that could be a little bit rough, where the neighborhood needs some improvements, and again, that's the whole purpose of this federal tax benefit, is to encourage investment in areas to revitalize them, to hopefully bring more economic development to those areas. But again, that census tract could cover areas that have already been revitalized or are in transition and have great potential for economic growth and development. So picking those census tracts, it's really key to have that market knowledge and to see where properties might be available in those areas. So reach out to me if you would like a free consultation on specific areas that might be good Opportunity Zone areas. You could email me at philip.ma@exprealty.com, and I'd be happy to set up MLS search alerts for you where I could have specific areas on the map that are roughly the Opportunity Zone areas, so that when properties become available in those areas, you can see what's available, and we can also search for off-market properties in those specific areas. Now, of course, you're also going to want to plan out setting up your qualified Opportunity Fund. You're going to need that to be able to purchase those properties. One thing you do not want to do is, let's say you had your capital gain realized and then you saw a great investment property that you wanted to invest in, and you didn't have your fund set up, you didn't have your LLC set up, so you decided to put an offer in your own name and then transfer that property into your QOF entity later. You can't do that. It's going to basically spoil the property. It won't be that qualified opportunity zone business property if you took title in your own name and then you transferred it into your entity. So these are nuances that you're going to want to talk about with your tax professional, and make sure that you're complying with those rules and not tainting the investments that you're making. So if your tax professional is not familiar with the opportunity zone rules, and I have talked to other investors where they've been using a CPA for many years, and the CPA just isn't familiar with these rules because it's just not a very widely known tax benefit. It came into being in the Tax Cuts and Jobs Act at the very beginning of 2018, and it just hasn't, for whatever reason, gotten a lot of visibility. But this is just a huge tax benefit that you could take advantage of. If your tax professional you don't feel comfortable that they have the expertise, I myself have been working with tax professionals, both CPAs and attorneys, and I'd be happy to provide you with a referral to a qualified tax professional in this particular area. And some of the professionals that I work with will provide you with consulting expertise. They don't necessarily have to take over all of your tax compliance work. So if you're comfortable with the CPA, for example, that you've been using for years, they can provide complementary consulting expertise specifically to these opportunity zone rules and work together with your existing tax professional. Once again, reach out to me for a free consultation on investing in opportunity zones. If you're specifically interested in the San Francisco Bay Area, I'd be happy to set up search alerts for you for listings that come available in those specific opportunity zone areas. Also, if you're interested in investing outside of this area as well as in other states, I'd be happy to provide you with a referral to other agents within my brokerage who are familiar with opportunity zones. It's important to work with an agent who's aware of where these zones are located and has a basic understanding of the rules. Again, we're not providing tax advice, but what's key to this investment strategy is investing in areas that have good potential. If you'd like a copy of these slides, I have a link in the description below this video where you can go. I do ask for your email address, and I will send you a copy of these slides and keep you informed about the Silicon Valley real estate market as well as real estate investing in general. And once again, if you found value at any point in this video, don't hesitate to hit that like, subscribe, and bell notification button. I'm Philip Ma with eXp Realty, and I look forward to talking with you very soon.